What is going on, guys? So I figured I'd do a video on 2 Canadian retail stocks and talk about whether I think they're a buy or not. Retail stocks typically trade at a pretty low valuation, usually due to the industry they're in. It's not a very glamorous, high growth, exciting industry. And sometimes it's actually a really great place to go to look for value. And you'd be surprised with the performance you could potentially obtain out of these stocks if you're buying them at a price that is, pretty beat down. Quickly, if you do want some commission-free trades on Questrade or some free stocks on Wealthsimple, 2 platforms that I both personally use and stand behind, links to sign up will be in the description or pinned comment. Also, come join the Facebook group where we talk Canadian stocks and a bunch of other nonsense. Link to join that will also be in the description and pinned comment. But without any further ado, let's get into it. And another great thing about these retail stocks is they're typically businesses that are really easy for people to wrap their head around. They can be, a store that you go to frequently, so you understand the business model. There's nothing, too complex about these. And so exactly for that reason, I'm not going to be doing deep dives into the, investor presentation. I'm not going to be explaining what the business does. I think it's pretty self-explanatory. This video is kind of a more analytic style video. I'm going to be really kind of doing a business analysis, talk about the fundamentals of the company, and then run them through a DCF model and figure out what price we should be paying for these stocks to earn a decent return. And then if things do look attractive, that's when I would step back and go, okay, maybe it's time to do a deep dive on the stock and see if there's more to it. And just a quick spoiler, one of these 2 stocks I'm fairly interested in. Like, the numbers were showing it to be a great buy right now. So I think that's going to warrant me to do a little bit more research on that company. And I'd also love to hear what you guys think. Is there a story there that could present this company with a great buying opportunity? I'd love to hear your guys' opinions on the business itself. But we'll get into that in just a minute. Also, I've made quite a bit of upgrades to my model. And so this is also kind of a dry run test of that. So I really hope you guys like what, I've added to this thing. And I hope it's going to really add a lot of value to these videos I make. So if you haven't seen my video on Shopify, this is basically my new model. So it starts off, I import the financials into here. I got the income statement, balance sheet, and really just the free cash flow section of the statement of cash flows. And then from this, I pull a lot of that data into this key ratios tab, which kind of gives me a lot of ratio analysis to tell me the state of the business currently. And then obviously my model, which you guys all know and love. But we'll get into that in just a bit. So I'm not going to go through the actual financials really quick. I'm more going to spend time on the ratio analysis and then the model. So the first of these 2 stocks is Canadian Tire stock, ticker ctc.a on the TSX. So this is obviously Canadian Tire. It really needs no explanation. I'm sure every human being watching this video has heard of Canadian Tire and knows exactly what they do. Just a quick rundown, they do own obviously Canadian Tire stores. They own things like Mark's Work Wearhouse, things like H&H, like a clothing brand or something, and they own Sport Chek, Pro Hockey Life, a couple other retail stores. It's a staple Canadian company that, like I said earlier, everyone knows about. So let's talk about the ratio analysis pretty quickly. I'm really get an idea of where this business stands, how well this business is being run, and what kind of health the company is in itself financially. So in terms of liquidity and solvency ratios, basically determining, if bankruptcy is going to be a problem anytime soon, and really telling us how this company is handling their debt situation. You can see that over the past 4 years, their current ratio has always been fairly stable, and you like to see that. It's in a good spot. Cash ratio over the past 2 years has really increased, and looking at their debt to equity ratio, it took a massive hike in 2019, but since then it's been declining annually. So what this tells me is that management's aware of their debt situation, and they're trying their best to keep it under control, and they're doing a pretty decent job of it so far. So that's obviously something you really want to see, especially with a lot of these retail companies. You want to make sure that they're handling their debt situation really well. And Canadian Tire appears to be doing just that. So it's a sign that the management's running the business all right. In terms of some profitability ratios, so gross margins, obviously for a mature business like this, you'd expect them to remain fairly average, and they are. Now, because this is retail, it's not the most high margin business you're going to find out there. Profit margin, free cash flow margin down here, really averaging 6% per year. But you can see there are signs of increases on both sides. Like I said, not the most high margin business, but it's good to see it somewhat looking like it's starting to increase. So in 2021, free cash flow as a percentage of equity, basically ROE, ROA, but factoring in free cash flow. These both took a bit of a hike. 2020 was a massive year. So if we look at this here in 2020, they both really spiked, and I would imagine that's kind of a pandemic anomaly. Like if I had to make a guess, I would assume this is due to stores being closed, so they're not paying a lot of employees, but at the same time, e-commerce sales were probably skyrocketing. A lot of people were ordering things online, and the actual stores themselves were closed down. So the e-commerce is obviously a lot higher margin side to this business. And what's really good to see here is that it's continuing in 2021. Obviously, it took a major step back. Stores were opening back up, but it is still substantially higher than it was in 2019 and 2018. So what this tells me, without even doing any research, is that this company is probably spending a lot of effort into developing its e-commerce platform, which obviously you really want to see. That's a massive growing market. And you want to see this company kind of changing with the market trends and really prioritizing this higher margin e-commerce. So that could be a growth story to really factor in into the future. ROIC, not very high at all. Again, this is a retail company. I'm not expecting it to be the pillar of profitability, but you would love to see a decent return on its invested capital. That's basically the money they're reinvesting into their own business, what kind of a return they're able to generate. And it looks like in 2021, it was a 5% return, which the S&P 500 yields an 8 to 10% annual return. So it's not a very decent return on investing in themselves. Ideally, I'd love to see this above 10% for any company. And because it isn't, so high, I don't mind if this company doesn't reinvest heavily into themselves because they're not doing a very great job of generating a sufficient return. I'd like this company to provide value to shareholders in other different ways, such as, paying that dividend, which they are, and buying back shares, which they also are. So like we just talked about, this is a dividend stock. So the dividend information is going to be we want to make sure that dividend's stable. And I'm sure it is because I think they only pay a 2.5% yield, something like that. And so I've got a little dividend free cash flow payout ratio calculator here. And based on their current free cash flow, 29%, based on their 4-year average, 32%. Typically, if I see this free cash flow payout ratio anywhere below 70%, the dividend, I usually consider it pretty safe. These are very safe dividends. They're not stretching their finances at all to be able to pay out this dividend to investors. So really good to see. And then in terms of valuation, you've got it trading at a 10 PE ratio, almost an 11 price to free cash flow ratio. Price to tangible book value, tangible, not just book. So that factors out things like goodwill and intangible assets. Basically, if you bought this company tomorrow outright and you liquidated everything and sold it, you'd only be able to get really 25% of your money back. And then price to sales, it's trading at 0.7. So fairly cheap amongst all these metrics, but you'd expect that, right? This is a retail company. It's not the most exciting, growing, fast-growing business. So and then over into the model here, I have made a couple upgrades, which you'll see down here in just a second. But first, let's talk about the assumptions. So in the low and high case for revenue growth, I've assumed 3% and 5% revenue growth. The 3% basically moving with inflation, and then the 5% revenue growth implies a little bit of actual growth of this company's operations due to its e-commerce platform, factored in with, a potentially higher inflation over long periods of time. Free cash flow, in terms of revenue, I have 4% in my low case and 6% in my high case, so very conservative. And share change, in my low case, I have them buying back 1% of shares, high case buying back 2%, and then trading at a 10 and 12 multiple of free cash flow in 5 years. And then basically, I want a desired return of 15% on the stock if I'm going to invest in it. And I always tell people do minimum 15% when you're doing any sort of DCF model, because you can literally earn an 8 to 10% return on average, historically, by just putting your money into index funds and taking on no firm-specific risk. So to actually take on the risk of buying an individual company and it not performing, your assumptions not coming to fruition, give yourself a bit of incentive and reward and use a higher desired return. So the share price is currently $185 as of the recording of this video. And under my high assumptions, it's a buy anywhere under around $200, low assumptions around $100. So a pretty broad range there. And when we're looking at the share price of $185, almost pushing that high range, it doesn't look very attractive to me personally. And I'll show you guys the changes I made here. So basically I factored in a weighted DCF price, which factors in both these, kind of averages them out, but places a little more emphasis on the low range just to be conservative. So it's weighted 60% towards the low assumptions and 40% towards the high assumptions, and finding a midpoint based on those weightings. And then I've also incorporated the Graham number. If you guys have ever heard of the Ben Graham number, obviously Ben Graham was the one who created it, legendary value investor, really known for obviously being the author of The Intelligent Investor and being the mentor to Warren Buffett. So he coined famously the Graham number. And this is a number I'd really use for businesses like this. So what the Graham number really is it's the square root of 22.5 times your EPS times your book value per share. And it was Ben Graham's coined metric of valuing a company. Anything trading below its Graham number is supposedly undervalued. Anything above its Graham number is overvalued. So the Graham number for this stock is 187. So it's currently trading at 185 per share. So it's trading under its Graham number. So factoring that in alone, it appears to be undervalued. So what I did is I took This weighted DCF price, based on my low and high assumptions, created an average, obviously weighting that, and then average that out with the gram number to create a weighted buy price. So it factors in the gram number and my weighted DCF price. Basically, I'm doing this to try and be as precise as I can to the actual intrinsic value of the stock. Factoring in all these, I'm able to really kind of hone in. And the more methods I use of valuing a stock, if I can create an average of all of these, that should, in theory, be much closer to the actual intrinsic value of the stock. So my weighted buy price for Canadian Tire stock is $164, and it's currently trading at $185. So it doesn't appear to be a decent buy right now for that 15% return. If we did change that to 12, it's still not quite a buy. 8%, we're looking at a buy for around an 8% annual return. So I don't know about you guys, I'd rather just put my money into an index fund. So Canadian Tire, to me, isn't the most interesting of buys right now. You guys may disagree. Let me know if you agree with my assumptions here. Do you think they're going to be able to, sustain that profit? Could they potentially see a lot more profits coming forward? And is there a growth story here? I want to hear what you guys think. But personally, to me, Canadian Tire, I'm not interested. And so that really transfers us over to the next stock here. And this is the one that I'm actually really interested in, this company. I think it's run incredibly, which you'll see when I get into the ratio analysis. And I think it's trading at a really attractive valuation. So it is Loblaw Stock. And this one's actually performed really well over the past 12 months, which kind of scares me a little bit. Like, I hate to buy a stock at these all-time highs. I love waiting, until a bit of a correction and I think there's a buying opportunity. But you'll see in the analysis here, the stock looks really attractive at these valuations. And I think it's really going to warrant me to do a lot more research into this company itself. I had somebody comment on my videos a few months ago talking about Loblaws, and they said due to their analysis, they thought it was a really great buy. And let me know if that was you and you're watching this. I really wish I really did an analysis like this at the time, because I would have done pretty well if I bought this stock, 6, 7, 8 months ago. Because you'll see, I still think it's incredibly attractive. So in terms of its liquidity ratios, current ratio remaining relatively flat, same with cash ratio, nothing crazy here, but their debt to equity ratio tells me this company is really, in a great position where they're managing their debt. They're not letting debt ever get out of control. They're not the most liquid of businesses, but I don't really expect this company to be. But I do really like to see that they're, not over relying on debt here. In terms of profitability, same thing with Canadian Tire. You'd really expect these kind of flat gross margins. And then profit margin, again, grocery store, right? This isn't the pillar of profitability. Free cash flow margin, same story, but it is actually starting to increase, which is really nice to see. They're appearing to become, over the years, much more profitable in terms of free cash flow. And now this is where this thing becomes really interesting to me, because I look at their free cash flow as a percentage of equity and their free cash flow as a percentage of assets, basically ROE and ROA with free cash flow, and their return on invested capital of 11%. Like, I'm looking at these three numbers and going, Jesus, this is a really, really well-run business. Like, management's doing an incredible job of generating return on, 1, their equity, 2, their assets, and 3, their invested capital. So this is a company that, and this isn't a one-off, you can see it's been slowly increasing over the years for all of these. This is a company that I really wouldn't mind reinvesting a lot of its capital into itself if it sees a decent opportunity. So again, this is a dividend pair. It pays around a 1.5% yield, which isn't very high, so expect it to be fairly payable. And it really is. So 12% of free cash flow and 17% of its 4-year free cash flow. This dividend's very safe. It's not going anywhere. You don't have to worry about a dividend cut happening anytime soon. So in terms of valuation, it's trading at a 23 PE ratio, which looks really rich on face. But you guys know me, I love free cash flow a lot more than I do earnings, because it does provide you with that more consistent kind of valuation metric. It can't be manipulated as easy, and it doesn't have, you don't factor in things like accruals as much as you would. And price to free cash flow is 8.6. So it looks very, very, very cheap on a price to free cash flow basis. Price to tangible book value is really absurd, but looking at the liquidity ratios, I'm not worried about this company going bankrupt anytime soon, so I'm not too concerned about that price to book. Like, I don't want to liquidate this company. And its price to sales ratio is 0.6, so very cheap on a sales ratio as well. Now let's transfer what we're on in the model here. And this is where I think, again, this thing's very attractive. You saw how well this company appears to be run in my ratio analysis. And now look at this. So for revenue growth, I've factored in 3 and 4%, basically, again, increasing with inflation. Free cash flow as a percentage of revenue, I've actually put on the more conservative side. You guys saw that it was, over the past year or so, a little higher. At 7%, it was 8% in the year prior. I've moved this to 6 and 7. And then share change, we can see they were buying back shares at an average rate of around 4%, 5% in the past year. They're buying back shares consistently at a really high rate, and they're accelerating the rate that they're buying back. I've assumed they actually slowed down their buybacks pretty substantially. 2.5%, which is lower than any of the past 4 years, and then 4%, which is fairly consistent with the average, in my high case. For the multiple, I have it trading at a multiple of 9 and 11. That's cryptic. In 5 years for each case. Then again, my return is 15%. Now look at this. So under my high assumptions, it's a buy at around 136. Low assumptions, it's a buy at around 92. It's currently trading for $100 a share. So on a weighted average basis, which again, 60% towards my low assumptions, 40% towards my high assumptions, it appears to be a pretty decent buy at 110. It's currently $100. So I can expect, just on this alone, about a, 17% annual return. That's really intriguing, guys. But when I factor in the gram number, which is obviously much, much, much lower, its gram number is around $56 a share, $57. The weighted buy price is looking around $83. Why I'm not too concerned about this is that gram number is being really weighed down by one, EPS, which isn't as high, its earnings aren't as high as its free cash flow, which I fully expect those earnings to catch up to that free cash flow. And also its book value, like you saw in the key ratios, was relatively low. So I'm not paying too much emphasis to this because, one, I care about free cash flow more than I do earnings. And two, the book value for this company, I'm not interested in liquidating this thing anytime soon. I think this company is actually improving their financial situation. They're not really quite stagnating just yet. So this weighted DCF price, like I said, that's yielding around a 17%. That's yielding around a 17% annual return if you buy it now. So for that reason alone, I'm looking at this at Loblaw Stock at $100 a share, like it's a pretty damn great buy. I also, another quick update to kind of the channel going forward, I don't want to do buy targets anymore. You know, like the classic buy, good buy, great buy that I've been listing on these videos. I don't want to do that anymore because I feel really corny giving, what I believe to be quote unquote buy targets for stocks that I don't have any plans on buying. It feels corny, it feels unauthentic. And then people hold me up to it. They're like, oh, you said it was a great buy. Are you buying now? And when I literally said in the video, I don't plan on buying the stock. And if I don't plan on buying the stock, why am I giving buy prices? So I don't plan on doing that going forward. But this is going to be where my buy prices come from, this model. So if you guys agree with my assumptions, if you think these aren't very aggressive, I don't believe them to be at all. This stock's yielding around a 17% annual return at these prices. I'll tell you where I do find the stock incredibly, incredibly attractive. Is 83. If I can get this below $84, I think it's a steal, absolute steal. But even if I factor in a 20% return, even in the low 90s, I think the stock is an absolute steal. You can see under my high assumptions, it's still a screaming buy. What would that be at the max? Around a 24% return, 23% return if my high assumptions come true. Which again, I don't believe to be ridiculously aggressive. Now, naturally, that's making me wonder, what am I missing here? And again, this is the reason why I plan on doing a deep dive into Loblaws. So off top, one, it's a grocery store. I don't particularly love that business model itself. There's nothing differentiating Loblaws products from Sobeys, from even Walmart. Nothing is, incentivizing me to go to Loblaws over these other grocery stores. There's no moat whatsoever. The only moat really comes around things, competitive advantage, comes around things like pricing, which obviously if you're Walmart and you're lowering your prices ridiculously, you're lowering your margins as well. So there's a trade-off there. But the only really way these companies can differentiate themselves is through pricing and through location, real estate. That isn't very easy to change. You either have a great location in a thriving, growing urban area, or you don't. So when I do my deep dive into this company, that's something to be looking at. Where are these stores located? Are they located around growing urban areas? When we think about, a grocery store like this, obviously 2020 was going to be a really high year because a lot of people were stockpiling a lot of emergency products like, sanitizer, wet wipes, things like that you would buy at a grocery store. People were stocking up on frozen food, things like this to avoid going to the store often. People were buying in bulk. People were going insane at points. I think why this stock performed over 2021 is that if you look at their, financials, they were able to keep up this pace in 2021 after 2020. I think a lot of people expected them to, after that decent growth year of 2020, I think a lot of people expected them to slightly take a step back. But they continued to show that, their foot's on the gas. But when I see a company this cheap, like I said, 17% annual return, it really makes me think, what am I missing here? So I hope you guys can really help me out with that. Like I said, I'm going to do a deep dive. Let me know if you guys want me to do a video on the results of my deep dive of this company. Are too many of you guys interested in this, or would you rather, me cover some crazy, stupid tech growth stocks instead? Definitely let me know your thoughts in the comments. Is there a reason the stock's trading cheap? Are any of you guys personally buying or interested in this stock? But with that being said, that's been my time, and I appreciate each and every one of you guys and gals for yours. I hope you guys enjoyed this video, really running over the changes I've made to this model and the quick valuations of these two companies and kind of analysis of their business operations itself. It's definitely a lot easier for me to do, so I could potentially do a lot more of these per week than the other videos, which take a lot more time, editing and doing research on. Let me know if you guys want to see more of these, but appreciate it again, as always, and take care, guys.